collaboration and action for all things to do with sustainability. With your co-host Nigel Lake here in Sydney, Australia today. I've finally made it back to Australia, which is where, in part, ESGX was born, and my co-host Paul Herman, who today is in Chicago. So we have a different city pair for the hosts. Coming up, we have a discussion about the new US infrastructure bill. But before that, we're going to come to our regular green jobs report and look at how is the US economy progressing? Are we really building back better? What might need to be done to drive more significant change? So with that as the very short introduction, I'll hand over to Paul Herman and our regular Green Jobs team, Fadel Kaboub and Amir Khalegi, to take us into the Green Jobs report.
Great, thank you. Good day, Nigel. From tomorrow, please let us know the lottery numbers since you have them ahead of time.
Absolutely.
And welcome, Amir. Great to have you here. And we're looking forward to the latest Green Jobs report. And we're also going to get into a little modeling of the US economy in a live Google Sheet. So the last jobs report, again, had some job additions. And it's showing that we're not building back better. Amir is going to cover that in a short overview. And then Dr. Fadel Kaboub of the Global Institute for Sustainable Prosperity and at Denison University, and Nigel Lake of Pottinger will come back. And we're going to talk about the infrastructure bill and how can we shift the US economy and other economies to be more impactful and to actually be better. All right, Amir, over to you. Feel free to get us up to date on what's happening with green jobs and those that are not green.
Perfect. Here we go. I apologize for the lighting. The daylight savings, everybody, is having to deal with these shorter days. So, can you see my screen?
Yes, and just make it a full screen.
Yep. Perfect. So thank you everybody for joining us for our monthly Green Jobs Report. I have a lot of exciting new modeling and information to introduce to you this month that just progressively increases our deeper dive on looking at the momentum and direction towards a more sustainable economy. For those of you who are joining us for the first time, our Green Jobs Report provides data-driven insights on greening the economy. We do so by leveraging human impact plus profit ratings, which is developed by HIP Investor. And these ratings are based off 7 pillars, which are health, wealth, earth, equality, trust, products and services, and management practices. From this, we provide a in-depth analysis by looking at over 2,000 HIP-rated US companies and cross-map those companies onto industry data that is provided by the Current Employment Statistics Survey. Once cross-mapped, we're able to provide a weighted industry HIP rating that places industries in their respective buckets of green, slightly extractive, and extractive. And for more detail, extractive industries have a HIP rating of 0 to 25. Slightly extractive industries have a HIP rating of 25.1 to 50, while green industries have a HIP rating of 50.1 to 75. So the question is, how HIP is the US economy? As we're building back from the COVID-19 recession, are we building back to a better economy or returning to our old habits? Addressing this, we can see from the graph that if we are looking at the blue line and the dashed line, the blue line is the economy HIP rating. And you can see from the onset of the COVID-19 recession / pandemic that there was a humongous downtick in job loss. Around 20 million jobs were lost. We can see this by the green, yellow, and red lines. So green industries were the most resilient to this loss with a reduction of around 6%, whereas slightly extractive and extractive industries suffered a much higher loss of around 10% to 70%. Those exact numbers will be on the next slide. But what happened was the HIP rating actually increased from the economy as unemployment increased as well, because the more extractive jobs were the first to go. Therefore, the weighting went up of the overall HIP economy. But as we built back and as jobs returned, we had the opportunity through things like the infrastructure bill to create better jobs, but rather we are returning to these more extractive industries. As you can see from the left side, as unemployment rate drops, so does the HIP rating of the overall economy. So looking further into the industry buckets, we can see here that this is this graph in front of us is looking at the cumulative change using February 2020 as a base. So we can see that from the overturn from March to April, there was a large reduction due to COVID-19. We can see that extractive industries lost around 19%, around 16% for slightly extractive industries, and 7% for green industries. Towards midsummer, as leisure and hospitality jobs returned, slightly extractive industries began to overtake the job growth as compared to greener industries. And currently, from the February 2020 level, slightly extractive industries are below that 2020 level by around 1.64%. Green industries is below that point by around 2.5%, whereas extractive industries are the most reduced with 3.61%. Currently, we're at 125.8 million jobs in September for total private employment, compared to 129.7 million back in February 2020. So looking here is the employment distribution for our HIP-rated industries. We can see that extractive industries is around 12 million jobs. Slightly extractive is the great majority of the employment ratings or industry employment ratings with around 197 million, whereas green industries, unfortunately, are the lowest with around 2 million jobs total at this point. But looking even deeper at the statistics for each of these buckets, we can look at the weighted average for each of the metric ratings that were mentioned prior. So HIP ratings are based on a weighted calculation of health metrics, wealth metrics, earth metrics, equality, trust, management practices, and products and services. So what we can see here is that there's a lot of information on products and services for each of the categories, and with slightly extractive even being marginally above greener industries in terms of the products and services that they provide. But there is a lack of reporting that slightly extractive and extractive industries or companies within those industries are lacking to do, especially when you look at earth metrics versus and trust metrics, looking at green industries versus slightly extractive and extractive industries. So again, this is weighted average metrics. Moving forward, we have the highest metrics, maximums pretty much within each HIP rated bucket. So looking here, you can also see how extractive industries have the lowest maximums, especially in terms of earth and trust, where the distance between each of the buckets is the highest, especially when it comes to extractive. But again, the lowest highs are pretty much found within earth and trust. But again, thankfully, products and services are still rating high, with the highest one even in slightly extractive being around 95%. Another statistic graph that we're looking at here is the minimums, the lowest metric ratings for each HIP rated bucket. And for slightly extractive, or for extractive, I'm sorry, there's a good portion of companies that provide no type of environmental data, and it is just, it's an issue. Same with slightly extractive industries. There's just a lack of information that is being provided, and it's something that we're actively trying to advocate for better modeling and just better ideas of moving forward and creating a more accurate picture of the industries themselves. Looking again too, for green industries, high levels of of reporting, which is resulting in higher minimums, the highest minimums comparatively between the slightly, like extremely large distance between the green industries and slightly extractive and extractive industries as it pertains to the lowest metric rating. So again, this portion of our Green Jobs Report is looking at the leaders and laggers over the month, over the monthly change. This is granular data. So granular data is released 2 months back. That's why we're looking at September data here. So for the granular data of the latest release, looking at the change from August to September, we can see that employment services, general merchandise stores, traveler accommodation, and child day care services were the top industry gainers. But something I want to take note of here is a good example of a good example of the metric ratings here is like the child daycare services. They provide an extremely high metric rating of products and services rating of 80, but unfortunately there's no environmental or earth metric metrics for the companies that are included in child daycare services. Thus, it hinders the human impact plus profit rating overall. But again, thankfully, there are a lot of good industry. There's a lot of industries that are providing net beneficial products and services. Moving on to the top industry losers, we can see that the top 4 industries here are special food services, nursing care facilities, community care facilities for the elderly, and college and universities. Sequentially, special food services lost around 21,000, nursing care facilities around 11,000, same with community care facilities for the elderly, and over the month, college and universities were reduced by around 9,000 jobs. Another point that we like to drive home is that green jobs pay significantly more. Looking at the levels of pay, average hourly pay, for the respective industry buckets, we can see that extractive industries are the lowest, slightly extractive in the middle, where green industries are significantly higher as compared to the 2 other buckets. Over the month, there was around a 20-cent change in green industries, around a 20-cent change in slightly extractive industries, and extractive industries saw around a 13-cent change for average hourly earnings. Also, to the point of greener jobs paying significantly more, they also have the highest wage growth over the past decade. And notably, slightly extractive industries have kept up, but we notice here that extractive industries are significantly lower. When comparing the levels, it's around 10% below slightly extractive and extractive industries. For those of you who have followed us before, you'd know of our high contact, low contact sector analysis. We mimic a study that was provided by the St. Louis Fed that combines occupational data and CES data to look at the industries that require high contact and the industries that require low contact, pretty much meaning they allow for social distancing. Cumulatively, since February 2020, the high contact industry employment is reduced by around 2.5 million, whereas low contact industry employment is reduced by around 900,000. But from our analysis, we can see that when divvying out high contact or above 30 and below 30, what we saw for both low contact and high contact is that higher rated HIP industries were more resilient as compared to lower scoring HIP industries. So this is across time, looking at across this year of this year's data of 2021. And we can see that, looking at the numbers, high contact is for below 30 is around a reduction of 5.5%. We're seeing a reduction level of around 3.8% for above 30 within the high contact industry sectors, which are the leftmost two columns. The rightmost columns are the low contact and low contact. Yellow is below 30, green is above 30. And we're seeing for below 30 around 4% reduction. Low contact for above 30, we're seeing a reduction of around 1.8%.
And Amir, this is so fascinating. You can see that higher rated HIP companies generally do better, right, even in the high contact industries now.
Right.
And so the more sustainably run, the more focused on people and planet and trust, are actually recovering jobs faster.
Right. And even still too, often I think there's a looseness over vaccinations are coming out, boosters are coming out, and it's almost like coronavirus is in the rearview mirror. You really feel it as you walk around, and even like masks are loosening up. And, even for my own self doing the analysis here, I'm like, is it still relevant to look at the COVID-19 or like say, resilient to COVID-19? Generally, greener HIP rated industries are more resilient. It doesn't matter if it is to a virus or a recession. They have protocols there that are triple bottom line, human focused, not just profit focused, that they do more to protect their employees from whatever the crisis might be. And even still, there are fears about this newer variant. There always will be newer variants like coming out. So it is relevant. It is relevant because although we saw for the first time this humongous pandemic, it's not going away anytime soon. So the economy will have to adapt. Like this, we can't be surprised anymore from things like this happening. We just have to come back and build more resilient to something that we have seen before, and not have this idea in our mind that, oh, we made it past this year or 2 years or whatever, and we're never going to have to see this issue again. Most certainly we'll have to see this issue again and continue to see this issue over the next, I don't know, I'm not a health expert, but I imagine 5 to 10 years or even more, who knows. Regardless, that's my spiel on that. So, as a conclusion, with all this information that we have just seen, it's clear, unfortunately, that we are not building back better. And for the second part of our discussion today, we'll be looking at, is the infrastructure bill that recently passed helping us really build back better, comparing, the original proposal to what actually got passed? Or as well, too, as Paul had mentioned, we'll be looking at this model of what industries have to shift, what job industries do we have to go into to raise this HIP rating of the economy and actually, materially build back better for better paying, more human focused jobs.
Super insightful, Amir. Really valuable insights that you're bringing out. And I really like your point about resilience can be to anything, to a shock in the system, to a recession, to a pandemic. There's forthcoming climate risk. And that's the thing about well-run companies who focus on people and planet and trust. That's one of the things that's distilled in the HIP sustainability rating is thinking ahead, being proactive, thinking across the whole system. And if we want our economy to be resilient, then the components of that economy, the jobs, the companies, need to be resilient as well. So as a bridge, I just want to reclarify on this chart, which is super insightful. The left-handed side, that's the HIP rating of the economy. So this is a 100-point scale. And 50 is what we might call the break even of being net positive, of treating people and planet and trust in a positive way. And below 50 is being extractive. And what we plot here is the proportion of net positive companies to net negative companies is negative for the US economy. And so while you can see the bump up when COVID hit and sustainable companies were more resilient, it only went from 0.05 to 32.35. It wasn't a big shift. And the reason why is the majority of jobs are in this yellow category. So almost 100 million jobs of those analyzed are in this yellow category. So let's do this. Let's invite Fadel. Amir, stay on. Let's invite Dr. Fadel Kaboub of the Green Global Institute for Sustainable Prosperity and professor at Denison University, and Nigel Lake, sort of global chair of Pottinger, and also, strategist of system solutions. Let's open it up for some initial comments from you, and then let's get into let's model what could be, and then talk about the infrastructure bill. So, Fadel, what do you think? What do you think the potential of the U.S. economy is? And then Nigel.
Yeah. Well, thank you again, Paul and Nigel, for hosting us, and thank you, Amir, for an excellent presentation. I'd like to underline yet again this concept of resilience that Amir is alluding to, that is extremely important for us if we really think about building back better, thinking about the future. That is not the next 2 or 3 or 5 years. We're talking about, transforming the U.S. economy. So resilience to all kinds of shocks, not just COVID, not just to climate change, not just standard kind of economic recessions induced by debt deflations or whatever it is. This is something that we've seen repeatedly from the HIP analysis that we've been doing. Number 2, emphasizing your clarification here, Paul, which is the entire system is badly extractive as is. So even though during the COVID crisis, we said the hipness of the economy improved because we've lost quite a few of those, mostly extractive jobs, it wasn't like we were above the break-even point. So when we talk about building back better, we should be aiming at least at a minimum at that 50 break-even point. And we're still in the 30s right now. So the question for us is the new infrastructure bill that has been introduced, which includes a little bit of climate, transformation. Are we in Washington, D.C., are we in board of directors across the country really thinking in transformative ways that will get us to that 50 break-even point in 5 years, in 10 years, in 50 years, in the context of what the IPCC has been telling us for years, especially this year, kind of ringing the alarm bells? Are we thinking in a deeply transformative way on a number of fronts? And here maybe Amir can go back to the slide with the different pillars, right? On the products front, on the reporting, on the transparency, on all the different categories. There you go. On the trust front, are we doing enough in each one of these categories to radically shift the composition of the workforce away from the extractive industries and to innovate and transform and invest and build resources and infrastructure in the industries that will take us to that break-even point, 50 and above? Because as we do that, not only will we decarbonize and bring prosperity across the board, create millions of jobs that pay better, that treat the earth better, that treat the health of workers and communities better, but also will be, meeting the climate challenge that the IPCC has told us about, and will be leading the way. If the United States is the leader globally in terms of economic power and geopolitical influence, if we're not going to be able to do it, if we're not going to lead the way, then what about the rest of the world, right? So these are the starting points for kind of segueing into the analysis that Paul will bring in later, kind of running a few hypotheticals to see what does it actually take to reach that point. And then that will tell us how committed we are and how much we're truly putting on the table today in terms of investments and commitments to transparency, reporting, and action at the federal, state level, but also on the private sector side.
That's fascinating, Fidel, and I'll just pick up on that since I'm sitting here in Australia, which is, of course, one of the great extractive economies of the world. Unlike many, a lot of the extraction has been done by locally owned companies, so at least the wealth generated has flowed back domestically. But one thing you see here is that once upon a time, Australia had relatively high fixed capital formation, i.e. the creation of real assets, not just financial assets. And that has declined substantially over the last 20 or 30 years. It's now at the lowest level really since anybody's, I think, maybe not since records began, but certainly for as long as anyone can remember. And there is significant concern in the Australian business sector about what that means. And of course, part of this just illustrates the point that once you've built the mining business, it doesn't create very many jobs. They're incredibly highly automated businesses. And looking at what's going on in the economy more broadly, we now have that same trend towards automation and robotization running through many parts of the traditional tertiary economy, which I know we've talked about before. So lots of administrative, clerical, even management roles getting automated. And so it's really interesting to think about the extent to which the green industries here are also industries of the future. Because there's a couple of big areas where the jobs will go as robots take over the things that robots can readily do. And that is, on one side, everything to do with kind of caring, creative, cultural, communication, collaboration type activities. And all of those, I think many of those fit within the green industries you have here. And they are industries which will create high levels of employment. The other part of this, of course, is renewable energy investment, which will create significant employment upfront as the assets get built. Over the lifetime, there will not be very much employment in those industries, but still probably more than mining, because there will be more maintenance involved than there are jobs in the mines. And I think that transition and what this means for employment opportunities is a very real and very tangible thing that is exercising the minds of a lot of people in business. And the practical challenge, and this maybe goes to the illustrations we're going to start to look at soon, is, okay, green jobs or jobs of the future, where should the investment be taking place? Where should we be trying to create both capital flows, and where should we be trying to create employment? And then what does that do to the economy as a whole?
May I underline one point that comes out of your analysis, Nigel, which is, all of these industries of the future, everything you've outlined by design requires higher skills in terms of education and technical training and so on. So if we're going to undertake this massive transformation of the economy, are we investing enough in education and technical training to produce the skills that will actually staff these industries that we're talking about? Or are we leaving it up to individuals to go find the training in a sort of a free-for-all type of system? Are we funding the free education and technical training to prepare the workforce to accelerate the transition into these industries? Which is why this discussion in the US about including free college education, public education as part of this transformation was so critical. And it's unfortunately one of the things that got cut. So we go one step forward and then we do one step back by not complementing it with the human capabilities that will actually transform the economy. That's the sad reality about what happened this month.
Yeah,
and
this is
a word of warning.
Go ahead, Nigel.
Sorry, Paul, go on.
I was going to say there's two infrastructure bills. There's the hard infrastructure bill, roads, bridges, trains, and there's the quote soft infrastructure bill. And that's about people and planet and trust. And so until we have fair pay and fair living wages and reasonable CEO pay and companies who don't breach trust by getting sued and greenhouse gas emissions reduction, unless we get those, we're just going to have a non-resilient, less sustainable economy. So, that's what these metrics are meant to do. Nigel, add on to what you were saying, and then let's do some modeling.
Absolutely. And what I was going to go to was, if there's anyone who's listening into this that's saying, but look, I just want to think about the traditional measures of competitiveness of our economy and of productivity. Well, this is precisely what is going on. What we're talking about here is radical productivity improvements in terms of not only financial productivity, but environmental productivity and social productivity. And the economies that get that right will benefit from enormous gains in competitiveness. And a word of warning to the US, China started on this game in the 1980s. The extent of investment underway in China in educating its people, in implementing renewable energy across swathes of the economy, keep a watching eye on what happens with its thorium cycle nuclear power development program, which can replace all of those coal-fired boilers rather more quickly than people might otherwise think. It has been on this journey for a really long time. And that's not driven, in my view, by China's desire to dominate the world. They don't. They just want to have a really strong domestic economy. And what's the biggest lever they've started to pull most recently? It's making sure that the wealth that emerges from this is distributed reasonably well into the economy and putting in place measures to make it harder for those that already have economic advantage to buy the right to stay at the top by saying, actually, we're going to intervene on educational training companies so the rich can't just make sure their kids get the best test prep scores. So China is shocking. I mean, for me, shockingly far advanced in its thinking on these issues.
Yeah, that's well. So this will be a great transition. Let's fire up the model here. So Amir, I'm going to take over the screen. And please put your questions in the chat or in the question box. We have another, up to half-hour discussion here. So what you just saw on the rating of the US economy is this, that a mix of the jobs are in the green, in the yellow, and the red. So green means the companies, the industries that have sustainable companies have risen up to the green. That represents about 2 million jobs in the US in the current calculation. The slightly extractive, below 50 rating, so maybe don't pay as well, maybe not treat the environment as well, maybe get sued. That's 98 million jobs. And then the super extractive, the ones that are mining and casinos and oil extraction and coal burning, that's 12 million jobs. So there's 6 times as many extractive jobs as there are green jobs in the US economy. And again, these numbers will flex up and down, and we're trying to capture as much as is reported. This doesn't capture necessarily all the private company impacts, though from what we've seen, public companies do have a slightly better influence than private companies in terms of sustainability from some sampling that we've done. Okay, so the weighted average, as Amir covered in the presentation, the weighted average of the green industries is about 52, so just over that hurdle. So we would need almost every job to be in this category to have the US economy. But 98 million jobs, 86% of the jobs that we're tracking are actually average about 32, 33%. And that's reflective of the US economy. And so when this number went down during COVID, we saw the US economy get a little bit better because jobs were shed in the red and yellow, but jobs were kept in the green. But now we're resorting back to the old economy. All right, so what could we do? what could be the difference? So I'm going to reduce this a little bit, and we're going to have a couple different scenarios. So scenario number one is, if we just increase the sustainability of the companies operating in the economy, let's just be aggressive. Let's just say we took dramatic climate action, paid people more, paid CEOs less, increased the energy efficiency, the climate action, and we're diverse. We're more diverse, like we're representative of the people in the economy. So if you raise the HIP score of these 2 million jobs by 20 points, which is a lot to raise it at. 72 is one of the highest scores of public equities worldwide. Highest is 79 or 80. So the average company would have to be dramatically more sustainable. And we even got 10 points out of the yellow. Because the majority of jobs are in this yellow, the HIP rating of the economy could go to 41%. So from 32 to 41. So that's pretty good. But as Nigel said, dramatic innovation and transformation. So, all right, well, what could we do different? And so what could we do different? Let me get the scale on this now. So let's just say we didn't change the HIP rating. People just kept operating as they do today. What if we increased the share of jobs? And we went from 2% to 5%. How would that be helpful? And if we go from 2% green to 5% green, and we shed some of those jobs, we went from 12 in the red to 5% in the red. We kind of increase. We'd go from 32 to 33. So let's just say, what if we had half the jobs in the green economy? That would get us to 42. What if we had 70% of the jobs in the green economy? That would get us to 46. So in order to, with no change of behavior, just to like shift towards greener industries, we would need 90% of the jobs to be in green industries. All right, but that's a simple model. So what would we do if we both?
Because I just jump in there, it also just draws out the challenge in some ways is less about the green industries and then almost less about the extractive industries and more about the enormous weight in the middle of just businesses doing ordinary things where modest improvements in their own sustainability over time presumably will have a profound impact on these ratings, or you could say on the competitiveness and resilience of the US economy.
And Nigel, the model bears that out. So even if we increase some green jobs, we go from 32 to 33. But if we transform how individual enterprises operate, we can make it to 41 with the same proportion of jobs, but radical transformation. Yeah. So if we did both, and this will be the bridge to the conversation about our policy choices. If we did both of, let's just make this, 35% job increase, and we did some radical transformation like Nigel suggested, we can get to that 52. We can get to that resilient economy. We can have a third of the jobs be green, cut the extractive jobs to 5. We could even say we're not even going to cut those extractive jobs. We could keep it at 10. Maybe we'll leave some extractive jobs so that extractive regions can be okay. We could even increase extractive jobs if we radically increased green jobs. And that would still give us a higher than 50, a net positive US economy. But it does require both. It requires policy shifts of what industries and companies, what behaviors companies are doing to increase their own individual resilience that Amir highlighted. Those companies that are more resilient lost fewer jobs and paid more. And we need some policy choices to shift this to try and get the economy there. And what that means is job gains in green. And then those jobs are migrating from yellow or red. Even if we add some in the red, we need to add 4 times as many in the green. Today, there's 6 times as many extractive jobs as green jobs. So we need to flip that ratio. We need multiple green jobs added for any extractive job. So all right, Fadl, you lecture on this all the time. So what do you think?
Yeah, so this, to me, the scenario, the last scenario that you showed where we finally break above the 50 point, the 50 break-even point, that's the Build Back Better. That's the minimum to call it the Build Back Better. what we have right now is building back slightly better, maybe.
Mm-hmm.
On a more serious note, what I would like to highlight is just give you one example of something that all of us have, seen in the media and heard discussed so many times, which is, how are we going to pay for it? This infrastructure bill is already too expensive, and we're sitting here and telling you that it's not enough, not even close, right? So the inflation concern that a lot of people have, and I'm going to link it to these categories that we have here on the screen. For example, the average container that we used to ship from China to the US pre-COVID used to cost $2,000 a piece. During COVID, in the last few months, it's up to $20,000 in some cases. And we've seen the backlogs and the kind of the delays in the supply chains and the ports in California kind of completely backed up. And yes, some of the infrastructure spending was specifically designated. I think 17.5 billion was specifically designated to boost the logistical capabilities of some of the ports immediately to kind of unclog the supply chains. But so it was the right thing to do, because that was part of the problem. But we've neglected to look further beyond just the port's operations and the shipping. We haven't addressed the transportation, the trucking problems that we have in the US. And you've seen, reports about the missing 80,000 truck drivers who refuse to go back to work, as if they don't want to work, as if so here's the problem. The way we regulate the trucking industry, the Uberization of trucking, which has been happening for a number of years, way before Uber, actually, creates a situation where for a truck driver, it doesn't make any sense to go to the port and wait for 8 hours unpaid. And as a result, count those 8 hours as part of your driving time, because you're regulated for safety standards not to be on the road for more than a certain number of hours per week. You're not paid while you're working. You get stuck at the port. It means that you're actually losing money. And that's why truck drivers are refusing to work at ports or drive anything from ports. And they're leaving the industry because they can't afford it. That's part of the problem. So we can't just deal with the infrastructure, the solid infrastructure, or the hard infrastructure, like you called it, without dealing with the transparency. And you've seen blogs and reports from all kinds of truck drivers over the last few weeks saying, we actually have to cheat. We have to pretend like we're sleeping, that we're not actually working when we're actually working at the port, because we constantly have to move forward and do paperwork and all kinds of stuff. But we have to cheat and say that we're not working. And that counts against our safety. That counts against our pay. That counts against our quality of life. So without having the regulatory framework that deals with the abuse that we have in the transportation system for truck drivers and other drivers too, we're not going to deal with this problem. And this goes across the board. And that's why the 7 pillars that we're looking at, we have to commit massive resources and care in adjusting the way we report, the way we analyze, and the way we commit transformative resources, so that we're not just unclogging the ports from a shipping perspective, but we're unclogging the whole system and are allowing people actually to participate and thrive on the job, as opposed to kind of concentration of power and logistical capabilities within a particular part of the economy. And we, the consumers, end up paying for it. It's not the truck drivers getting paid more to deliver.
Amir, what about you? What are you seeing as, what are our levers here? Is it more improvement, more policy change, something else?
Well, when looking at the infrastructure bill of what the original proposal was versus what was actually passed, what I did notice is the funds for schooling and building and housing, affordable housing, the soft infrastructure, as you say, perhaps, but also a little bit hard in terms of the actual materials, in terms of constructions it would take. I noticed a lot of those being taken out, and it goes against from the Building Back Better. Like these types of housing, schooling buildings, or home and community-based cares. For those of you who've been following us for over the past year and a half, we've done a deep dive in the community healthcare and the type of how many jobs that could create. I believe from our analysis, it was around like 2 million in these in need areas that would have great job creation. We are neglecting. And I think we could be doing better, but I think unfortunately it's behind the numbers and asking how will we pay for this. I think as it was said today, a lot of Chicago school thinking where the more money that's in the economy, thinking that higher inflation rates, but as Fadl pointed out, a great extent of inflation is due to supply chain bottlenecks that have been prevalent since 2020, and chaining that in to what Fadl had said about the truck driving industry and just I guess general extractive industries in terms of the human perspective. We created around 500,000 jobs over the last month, I believe. From August, or no, the October numbers showed around 500,000 jobs created, but the rate of people quitting increased significantly to a higher point, one of the highest points of the pandemic. So although we're adding back jobs, perhaps directly, not perhaps, it is directly correlated with benefits ending, people are still saying, Fadl was just saying, truck drivers are leaving the industry. I don't want to deal with this, right? These inhumane practices. People don't want their time wasted. They don't want their health to be affected. The transportation, driving, exposing yourself to dangerous conditions while trucking, being on the road too long. If they're not being fairly compensated for the important job that they are doing, allowing the economy to run, and these, workers are not being valued, then of course people are going to quit, and it will cause things like inflation because of the interlinkage of everything within the economy, not just how much money is in the economy. It's not that simple of a one band-aid fit all. So the soft infrastructure and hard infrastructure has to work in a coordination to build back better. You can never just build one side of things. You have to do it as a cohesive, interconnecting web.
And I'll just jump in, and this is some of the message that all of us can bring to the discussion is soft infrastructure has a high return on investment. It probably even has a higher return on investment than hard infrastructure. So investing in people and education creates lifelong talent and skills. And Nigel was talking about that in China. So for-profit institutions in education in China just got banned. You cannot make a profit on education, and they want you to do it as well. Or if you walk around any city in Asia, you'll see lots of language training as well as mathematical training and quant training, and even Wall Street training classes on the subway in Bangkok and Hong Kong and Singapore. So I think the message that's missing is we can get double-digit, triple-digit return on investment from soft infrastructure versus single digit or maybe teen return on investment from hard infrastructure, which we need. It's not where you don't need it, but there's higher return on investment. Nigel, what have you seen in terms of return on investment of hard versus soft infrastructure?
Look, I think it's an incredibly important point, and it's very easy for people to argue that they don't really believe in it and then cut the spending from these bills. And month by month, you don't see much change. But progressively over time, you absolutely do. And, I saw a version of these issues when I first moved to Australia, which is in the early 2000s, in that the Australian economy was very heavily geared to old economy industries. And even today, the ASX 100, and even with quite a generous definition of what a new economy business might look like, is still clearly 80% old economy industries. And what does that do? Well, if you just want to talk about pure financial returns, the Australian Stock Exchange, the ASX 100 index, has grown at something like 70 to 75% of the growth in the economy. So the stock exchange has grown more slowly than the economy as a whole, which is something I find almost impossible to comprehend how that could possibly be. You compare that to the US, where the stock exchange has achieved dramatically greater returns over time. And that is, why is that happening? It's because the value that's being created in economies is accruing much more to the new economy businesses. And in the case of the US and China, for that matter, that's where most of the new economy businesses make their homes. And you see a practical example for any Australians listening in is, the largest company in Australia today is Commonwealth Bank. Its market cap is about 160 something billion Aussie dollars. It's added about 140 billion Australian dollars of market value since the year 2000, which is the same as Atlassian has achieved, the software company founded a few years after that, which employs about 6,500 people. So, the value is being created by highly skilled people in a relatively small number of businesses. And if you're not home to those businesses, which outside of the US, China, and I think Israel, essentially almost every country isn't, then there are huge risks as to what will happen. The share of unicorns, Australia looks quite good right now at 1.7% of the market value of unicorns on the planet. But that figure is 80% dependent on a single business, Canva, which most people have probably heard of. If it wasn't for that one business, then Australia's share of unicorns would be massively lower than its share of GDP, which illustrates the problem, because these are the businesses that are creating the opportunities from a wealth point of view, slightly different in terms of the employment creation, because the businesses that create a lot of employment are not necessarily crazily highly valued tech companies, but are incredibly important to the fabric of society. So that's a salutary warning. If you don't do this, you will wake up one day and say, why is my country broken and no one wants to invest in it?
Yes, that is very astute. And so it takes individuals like all of us in the audience here to take action. It takes influencing our companies to be radically innovative, like Nigel suggested. It takes smart policy choices into soft and hard infrastructure, like Fadel has advocated. And it takes to actually do things in action through all types of resilience, like Amir has advocated and identified. So I think the real strength here is take action in your own companies with your own behaviors, and even in your portfolios, even getting your company's 401k or 403b to shift towards sustainable funds. The new Department of Labor guidance will be coming out soon. And there's an open SEC Securities Exchange comment period by December 13th, so 2 weeks from today. So that's something to get your voice put into the Department of Labor, SEC, the Department of Labor ruling on 401ks, on how your choices could be more sustainable. All right, so we just have a few minutes left. Let's talk about any other action items or any other questions from the audience. One, we have two questions from the audience. The first is, how do I learn which companies have the highest HIP rating? We have a HIP investor portal that you can do a free trial on. Some of you may have already signed up during the call. So if you go to hipinvestor.com, you can see some examples of those higher HIP ratings. And some of them are also described in the books that we've published, the HIP Investor book and the Global Handbook of Impact Investing. All right, here's a second question from Chris Gassman. How can communities do similar economic analysis in order to spark action and benchmark their progress over time? Maybe even at the subnational levels that universities collaborate on. So Fadel, I know you have no less than 3 examples of Appalachia and Pennsylvania and maybe even Ohio. So maybe you could put those links in the chat. But Chris, I think, is working in Pennsylvania and Ohio area. but you've done some of these analytics, right, and how these regions can be more sustainable and the return on investment of soft and hard infrastructure.
Yeah, I think you're referring to the cost of doing nothing type of analysis, which I'm happy to comment on. But I thought, at least the way I was reading Chris's question is maybe a reference to the scenarios that you displayed a few minutes ago, but done kind of HIP analysis of local state level job markets and benchmarking targets. I'm happy to let you comment on that.
Let's do both.
Yeah, let's do both. All right, so I'll start with a quick reference to the cost of doing nothing type of analysis that we've been working on here in Ohio, Pennsylvania, and West Virginia, which is essentially looking at the cost of inaction and showing that the amount of money that we're currently paying, not just money, but blood, tears, and money, as we say, in terms of lives lost and lost productivity and social cost of carbon from CO2 emissions from coal mining and burning coal and natural gas and fracking. The numbers, which I don't have the numbers in front of me right now, but I'll make sure to share them next time. The numbers are astronomical compared to the cost of doing the right thing, which is investing in infrastructure, investing in people, investing in transformative policies that will actually improve the overall hipness of the region and overall hipness of the US economy. So common sense, right? If the cost of doing the right thing is cheaper than the cost of doing nothing, then do the right thing. It's cheaper, and it's healthier, and it's transformative in the way we've been discussing today.
Yeah, and I'll put the state of working in Pennsylvania in the chat for everyone to take a look at, and Fadel may have some other links in a moment. But yeah, the answer, Chris, to your question is, whether it's Pittsburgh or the Pittsburgh metropolitan area or the state of Pennsylvania or Appalachia, which there's a previous ESGX on reimagining Appalachia that you can listen to at esgx.org, as well as in Ohio and West Virginia, which have this need to create jobs, boost income, be more resilient. This is a analytic that can be done of spurring innovation in companies, like Nigel said, transformative innovation, building resilience, like Nigel said, and then starting to shift government policy, as Fadel speaks about at the sovereign level as well as the regional level. So these are all possible. So you can see in the chat reimagineappalachia.org as well as keystoneresearch.org for some additional analytics. All right, it's the top of the hour. Boy, this time went fast to reinvent the world. So want to thank everybody, our producer, Nick Gower, Amir, thank you for your monthly Green Jobs Analytics, really insightful. Thanks for continuing to enhance that. Dr. Fadel Kaboub of the Green Global Institute for Sustainable Prosperity and professor at Denison University. And Nigel, thanks for bringing us into the future of tomorrow from Australia, where I'm sure you're pushing these innovations with the conversations you're having there with business and government and nonprofits. And thanks each of you for joining. Please feel free to share this ESGX either from YouTube or ESGX Live. Nigel, do you want to wrap up and talk about what's next?
Yes, so I think we're pretty much at the end of the year for our program. And so please stay in touch. We will reach out with any further events for this year if there are any, but also with our program for 2022. I think we have some really exciting things planned. And I was just going to leave a couple of parting thoughts. One is, in everything you're doing in your business, think about, whenever the subject of automation comes up, how can you use automation to free up resources, to humanize your business in some way, to put more human content into it? Because ultimately that's what people like, and will drive better employee engagement. It will drive better relationships with your suppliers and with your customers. A second part of this is, in everything you do, think about the 5 C words that line up with a quaternary economy, the place where all the jobs will be, which is creativity and collaboration and communication and caring and culture. These are all intrinsically human things. And if you can put that into your businesses, that will differentiate you from others. It's also a good thing to encourage children to think about as they're choosing paths into university and beyond. So study STEM subjects, but think about how those can be used to drive these human things, not just to automate everything. And I think the last thing I was going to say, for anybody wondering what this flag is behind me, it's the pennant of the Trans-Pacific Yacht Club, rather appropriately, from California. And for me, it's a reminder that there is always an opportunity to act. So none of this is worth anything if all we do is talk about it. We have to find ways to act. Pick a destination, get on the boat and sail it there. Of course, sailing being much more sustainable than other forms of transport. So I think that's it. So it's a fantastic discussion. Thank you all very much. And we look forward to seeing you again soon.